Hello, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. All right, this is September 5th after the market close. That is the timestamp you're looking here at the Yahoo Finance homepage and the big headlines, the things I want to get into today. The biggest one was the jobs report that's going to set the tone for a lot of the both policy and financial market action for this month. All right, let's just dive right into the charts. The jobs report was weak, as you can see with this headline here, and the expected reaction, from Washington, D.C., from the White House. We had a big earnings announcement from Broadcom. Let's get into the charts. All right, market breadth. Well, the market gapped up. It celebrated. Now, you might be thinking, why would the market celebrate job losses or a job slowdown? And when I say job loss, the revisions, which of course now were very closely watched for the jobs report, the revisions showed negative job growth, meaning we lost jobs in June. And then there were other downward revisions for July, and then August was, I think, slower than expected. The unemployment rate went up from 4.2 to 4.3%. I think that was expected. I never really pay much attention to expected or consensus because those predictions could be wrong or right for just random reasons. Anyway, so you're wondering, why would the market like to see weak employment data and weak economic data? Well, it's because it locks in the Federal Reserve into cutting rates to combat the slowdown. And when I show some other charts, I'll show some of the implications of the market's anticipation of basically certain rate cuts for this month and maybe rate cuts for the rest of the year, for the rest of the Federal Reserve meetings for the rest of the year. So here's market breadth. You can see the celebration caused market breadth to expand right at the open. So we went from, what was this, 62.4% yesterday and open today at 65.7%. And we could have gone all the way to the overbought threshold of 70%. And sorry, this is market breadth, the percentage of stocks trading above their 50-day moving averages, what I like to call AT50 for above the 50. But sellers stepped right in after the open and faded the market for the rest of the day. We even had complete closes of the gaps, like for instance, market breadth closed, reversed all of its gains before rebounding slightly for a tiny, tiny gain. So we started the day with a celebration, but then people started getting a little wary, probably because of the tug and pull between, hey, great, rate cuts are coming, but then, oh no, the economy is slowing. So which of those two is going to win out? It's going to be a constant battle, and we won't really know how this plays out until the economic data really starts to roll in after the rate cut cycle begins. All right, so now, while the percentage of stocks trading above their 50-day moving averages or AT50 kind of disappointed, you could see here that while the percentage of stocks trading above their 200-day moving averages, what I like to call AT200, opened up at 63.3% for a new high that went all the way back to, let's see, it went all the way back to last December. It faded, but still had a decent gain and just barely missed the previous high for the year. So this longer term indicator of market breadth looks ready to break out. So if I were only to look at this, I would say the underlying technicals of the market remain very healthy, although my overall short-term trading call in the market remains firmly in the neutral camp. And I've explained this in my blog at drdrew.com/122. Okay, so those are the market breadth indicators. This is my favorite way of looking at the market. Let's go into the indices. I will change to a logarithmic style. So, if we were to step back on the S&P 500, we basically say there's been very little to talk about for months because this trend has been very persistent and well defined by the 20-day moving average, which is this dotted line. If we zoom in a little bit, there is a little bit of excitement just because of the few times that this support has been challenged. But most importantly, we just missed setting a new all-time high. And you can see here the impact of the celebration at the open and then the gap down, sorry, the reversal and fade actually caused the S&P 500 to lose 0.3% on the day. But still, this uptrend is well intact. So nothing fundamentally has changed about the character of the trading in the index. Same thing for the NASDAQ. You see the NASDAQ has a very similar look. It actually looked like it was going to close cleanly at an all-time high, but instead the faders took the NASDAQ back to flat. And I just want to do a real quick look at the triple Qs. Um, this is the big cap. This is more dominated by the big cap tech stocks. And just on Tuesday, the beginning of the week, it looked like we were going to get a breakdown and then further sell-off. So I almost called this whole thing the redux of August, because you remember in August we also had a big drop down. Actually, let's go back to the S&P 500 so you could see this. Back when August trading started, the S&P 500 fell significantly for the recent price moves, 1.6%. And then when the S&P 500, when this week opened, holiday shortened, it lost 0.7%, but only after a rebound close to the 50-day moving average. So you can see buyers stepped right in, learning the lessons from August. Buyers stepped right into the opening selling for the month. And because they bought right at the 50-day moving average, you can see once again the technicals are dominating the theme here and dominating the narrative. The technicals mean a lot here in the short term, and that's all that this trading has been. Okay, so I needed to point that out that I almost call this redux of August just because of how we opened the month and how buyers eventually stepped in and saved the day. Now, ETF of small caps, IWM, the iShares Russell 2000 ETF. You could see that it is the champion because it actually managed to close positives up 0.5% for the day, which is a new high going back to December. That December marker is going to come up a lot here. Keeps coming up, I mean. So IWM is looking better than it's ever looked. Its uptrend is now more solid, wavered a lot back here in August, July and August, but now it looks pretty solid. So the big benefit that it's getting is in a rate cutting cycle, a lot of these stocks that are more speculative, may have a lot of financing needs, are really going to benefit from lower rates. So small caps should continue to outperform the bigger caps and should continue to outperform, sorry, and the IWM should continue to outperform the S&P 500 and the NASDAQ. And if you've been watching my videos or reading my blog, you know that I have a large and substantial position in IWM since last year, and I've been building and building and building it in anticipation of an eventual cycle, just as we're finally getting now. So I also have call options that I kept going into next week as well on IWM. As a reminder, I'm trading around those positions. Um, I'm providing all of this information, so all of this analysis and information for your informational, educational purposes only. Please, when you trade and invest, use your own risk management rules, your own time horizons, and your own objectives. Okay? And of course, past results do not guarantee future performance. Okay, let's continue on. There's a lot to cover here in terms of the action on individual stocks and indices. Let's first see the impact of the slowing economy. People rushed to bonds. So the typical pattern is when the financial markets fear an economic slowdown, they rush into bonds. And when bonds go up in price, sorry, when bonds go up in price, yields go down and vice versa. So bond yields went down and the price went up. So TLT, which is the iShares 20-year Treasury bond ETF, broke out above its 200-day moving average for the first time since April. Since April, back when the market was the most scared. So that was back when people rushed into bonds because they were just scared about the tariff trauma, drama, and noise. Now people are getting more scared about the economy. Now, I went ahead and faded this. Again, if you read my Inflation Watch blog, I've been fading rallies in TLT only because at some point the realities of inflation and sometimes stronger growth come back into the mix and bonds sell off and yields go up. We have a CPI report coming up next week. CPI is a consumer price index. So we're going to get another read on inflation. And that read should remind everybody that inflation has remained sticky and low, woe to us all if the inflation report actually shows a higher read on inflation. Right now, it's been sticky and has been stayed elevated. So the Fed is going to be cutting rates into a sticky inflation environment. And I just don't trust TLT to remain aloft in this kind of situation. Now, there is one market that is hip to what's going on, which is gold, the precious metals market. Gold broke out just as many of us gold bugs would have expected. That it broke out cleanly at the beginning of this holiday shortened week with a massive 2.4% gain and has had a positive bias because gold is anticipating the rate cut cycle into an inflationary environment. So I am long a call spread on GLD, and now I'm waiting for the next pullback in GLD to add to the position or create a new position. I love gold here, and I expect it to just keep going higher as long as we have these conditions of lower short-term rates into an inflationary environment. I've been talking a lot about the bearish to bullish turn in home builders. This is ITB, iShares US Home Construction ETF. This benefits a lot from rate reductions. That's the typical conventional thinking. Now, it's worked, and everything I've written about has played out as I would have expected. And I did sell some ITB call options into today's, sorry, I took profits on ITB call options into today's pop. ITB pop 2.2%. I still have a very large core position in ITB, and I have one more home builder that I sold a call against. Again, I've written about all of this on my blog. But I want to point out here that because inventory conditions are tight, homes are already unaffordable and very high priced. I think we could be in for a surprise. I haven't fully developed my theory enough to write about it, but so you're hearing me kind of ruminate about this for the first time, but I have a thought that once rates start going down, people are going to be very surprised at what happens in the housing market. Yes, demand may increase, but supply may not increase as much as possible, and we could see home prices really take off. That will add to inflation, that will make gold even more attractive, and worst of all, it means that the sales component of homes may not actually react that much because supply won't be responding and because not everyone who wants to buy a home is going to benefit from lower rates because prices are going to rush up into that lower rate environment. So this is something I'm watching very, very closely. Okay, let's go on to some other individual stocks. Broadcom was the big uh, story for today. It had an earnings report. I've written about Broadcom. This is a stock that I used that I found with stock chart, sorry, with Swing Trade Bot, my favorite stock scanning tool. And I can't remember exactly when it triggered, but I'm pretty sure it was around here when Broadcom hit this 50-day moving average. It tested, it bounced off. I jumped into a call spread. Now, at the time, I didn't realize that the call spread was going to expire this today, right after Broadcom reported earnings. But since it had this very slight upward trend and it bounced again off 50-day moving average support, sorry, Broadcom is ticker symbol AVGO. The 50-day moving average is this red line. I dared to just go ahead and hold it. It's an AI play. I'm still bullish on most AI plays. And this one just happened to work out. Sometimes it's better to be lucky than to be good or smart. I just took a risk, and that risk actually worked out extremely well. AVGO soared 9.4%. Sorry, closed up 9.4%. It was as high as I believe 12 or 13% at the open. It's a really weird. This was a really weird one because Broadcom in the aftermarket yesterday first was down, then it was up maybe 2 or 3%. So I did not expect to have this be my best, essentially almost one of my best trades of the week. So again, this just happened to work out, but it is another case of where the technicals can really benefit. I mean, look at how beautifully Broadcom held the 50-day moving average support. Now, I never promote technicals as an indicator of what's coming in earnings, but when it does work out like this, it's just a beautiful thing. Now, Broadcom had some interesting things to say about AI, and in particular, they're offering AI, custom AI chips to OpenAI, and that caused some tremors in the AI trade space. So, for instance, this made people scared of NVIDIA. Ticker symbol NVDA. It was down more. It was well below its lower Bollinger Band. It lost 2.7%, so it didn't participate in today's celebration. And this double top essentially now is confirmed. I talked about this earlier that NVIDIA was forming what I called at the time a subtle double top. Now that double top is confirmed because the 50-day moving average breakdown is confirmed. So this, believe it or not, makes NVIDIA bearish. I am not going to chase it lower unless NVIDIA manages to close lower again. I might consider as a short, but NVIDIA is a much loved stock. And the only way that NVIDIA continues to go down is if the entire market goes down, and really the market seems, it's more bullishly inclined. So I'm just guessing that buyers are going to just keep stepping in into these dip opportunities. But we'll see. I don't have a position in Nvidia, but I do have a position in advanced micro devices, ticker symbol AMD. You could see buyers did not step in on AMD at the lows, unfortunately. It got walloped 6.7%. It didn't confirm a 50-day moving average breakdown because it managed to cling to support earlier in the week, but this was a clean break. AMD is now bearish. You don't even have to wait for a confirmation on this one. I'm holding my position. I've been holding it for a long time. I built up some more shares back in the sell-off earlier. I have just decided to commit to AMD for the long term, so I'm not trying to trade in and out of it. I will of course look back if AMD continues to sell off to 200-day moving average support, which is this blue line. I'm going to look back and wish that I took profits or at least stop the losses, but there's no regret here. This is just the rules and the strategy I laid out for myself. Now there's another AI play. This is actually my favorite one, which is Vertiv, ticker symbol VRT. And it too showed some weakness, but its weakness started earlier in mid-August. I did buy some more around the 50-day moving average support. It had a very tepid post-earnings response back in July. I'm not 100%, I don't quite know why the market is so hesitant about Vertiv right now, so I'm a little wary that this sell-off or this pullback could expand or accelerate. I'll be looking to see what happens when when or if it tests the 200-day moving average, this blue line. So just keeping an eye on that. I'm also a little wary of my position here because it essentially made a double top after earnings. You can see it stopped just short of making a new all-time high. So that's a little concerning to me that Vertiv may actually be topped out. But it'll be hard to really know until more time evolves. Okay, now another big star of the week was Google. Google got saved by the Justice Department. I think it was the Justice, no, not the Justice Department, by the judge who's handling the antitrust case. Essentially, they woke up and opened their eyes to say, hey, the environment in which Google operates now is so much different than when this case was started. AI is threatening Google's business. It doesn't have as much monopolistic power as it did, as it seemed to have earlier. And so they let them off the hook. And I won't go into the whole case, but the big thing was that they can now keep paying, ironically enough, Apple for access as the default browser. So now they get to keep giving Apple money. Of course, Apple also benefited. I really slipped up on this one. I'm bullish overall on Google because of AI, because of the cloud business, because of the ad business, because of search, and because of YouTube TV, which hardly ever gets mentioned. So they've got just an amazing slew of properties. I expect Waymo to also be big for them at some point. So I really slipped up on this one. I should have been buying into Google after its last earnings in July. I let this, I mean, look at this nice and easy ride upwards in this uptrend. I think I did trade in out of some call options somewhere in here. I can't quite remember. So this is a really big miss for me. Now Google, continued the buying momentum for 3 straight days. All I can do now is just wait for a pullback back to some support level, say A nice support level might be 220, which is like, I think about halfway reversing the gains, but who knows what's going to happen from here. Okay, a lot of talk about the employment situation. Upwork dropped today 3.5% in the wake of the slowing jobs report. So that's expected. I was surprised to see how strong the momentum has been in Upwork. Ticker symbol UPWK. They provide contract freelance labor online. Sorry, for hire online. So it stopped short of the last high. So this could be topping out for Upwork. I keep my eye on it because it's a play that I liked from back in the pandemic days, but it just hasn't regained its mojo, and it looks like it may be topping out again. So I'm not going to jump in here unless it tests one of these nice support levels, the 50-day, 220-day, or 200-day moving average. Okay, now I'm going to end this with some talk about retail because, of course, if the job market is slowing down, overall aggregate incomes may come down, and that will hurt retailers. The story on retailers this week and today was actually mixed. So it's clear that investors aren't so afraid. Maybe they're expecting rate cuts to save the day for the retailers. Dollar Tree did I've been remarking about how Dollar Tree and its competitor Dollar General have done so well despite the earlier concerns about tariffs. Dollar Tree unfortunately followed Dollar General's lead and lost actually even more than Dollar General did post earnings, lost 8.4%. And you can see that it's just all the air has been let out of the stock. Didn't go anywhere. It doesn't look like a recovery is coming anytime soon, but I am keeping an eye on it for a potential buying opportunity. I think Dollar Tree's issue was tariff related, some increased costs that it's still trying to manage its way around. So that's one story. Another story on retail was much better. Macy's soared out of the gate. Now I think Macy's is a highly shorted retailer, so it jumped out the gate. What was this? Macy's ticker symbol M. 5 point. Oh, sorry. Trying to get this. Oh, there we go. 20.7%. And you can see the buyers just kept the pressure going the rest of the way into the week. Now, even though Macy's soared all this much, it still didn't pass its last high or last peak, which was way back in, guess what, last December. So until it passes over that peak, this could just be another relief rally in Macy's. And let me just scale back just to show how poorly Macy's has been doing overall. You could see it got some love during the pandemic. It soared up to 37.4, sorry, $30, $37.40. But even that post-pandemic high was well below where Macy's used to trade. Let's see, let's take the weekly look. So you can see its big peak was way back here in 2015. So it's often good to keep this perspective in mind when these retailers and other smaller stocks soar like this. You have to see where they've been to really understand whether this is significant. And for Macy's, no, it's significant just for this on the daily basis if you're a short-term trader, but in the larger picture, it's not significant yet until it really stops that bleeding from the overall downtrend that I just showed. Okay, Zoomies, I think it's pronounced Zoomies, ticker symbol ZUMZ, maybe Zoomies. It also had a great day, up 15.5%. This is definitely bullish in terms of short-term trading. You can see it rallied strongly going into earnings. It's well above the upper Bollinger Band, so it's overstretched. I wouldn't be buying it here. I'd wait for it to cool down or to pull back. And as always, like I just said, I got to pull back and see where this stock has been. It's a crazy move today, but sure enough, this stock has just flailed around for almost 20 years. Let's just call it 20, 21 years. Sorry, 20, yeah, 19, 20 years. So, yes, today was a great day for the stock, but in the larger scheme of things, it's meaningless. The stock is just popping around. If you're a quick trader, you buy it when the stock is selling off down by these lows, and then you take profits when it gets towards one of the peaks, and it's getting close to one of those peaks. If it could get above that, then the next resistance level will be around $29.31. So this is not a stock I'm putting on my buy list because I don't want to be in the business of trying to predict when and if it's going to hit the upper or lower part of that trading range. Now, finally, Lulu had a terrible day. The technicals are kind of telegraphing how bad things are for Lululemon Athletica Incorporated, ticker symbol LULU. Post earnings loss 18.6%. I've had some bad trades in Lululemon trying to predict when it was going to relief rally, when a downtrend was going to continue. It seemed like every time I tried to bet on a continuation of selling, it would go into relief rally. Then I would jump into a relief rally, and then that rally would run out of gas. So I just kind of threw up my hands and left this stock alone. Otherwise, I would have been brave enough to have gone into this last earnings with some put options because Lulu is obviously just in a bad way. It was a stock that was flailing around in an extended post-pandemic trading range. You could see here. And then it broke down below that first in last year, August, and then it zipped back up, stopped short of the all-time high, and that was the signal to sell or to short. And the stock really hasn't been the same since. It's just this constant downtrend with one more fake out above the 200-day moving average. So until something fundamental changes for the business, I think Lululemon is one I'm going to try to fade again. Let's see if I get the timing right. All right. So that is all for today. There was, of course, a lot more action. Remember, September is full of potential catalysts. We now have gotten through the jobs report relatively unscathed. If I think about the overall aggregate picture, remember, market breadth is actually still looking pretty healthy despite some of these individual stocks that are having a lot of problems. Um, we have the inflation report, CPI, next week. I think it's Tuesday or Wednesday. Don't quote me on that. And then the following week is the big Federal Reserve announcement. We're going to get a rate cut, but are they going to be dovish about it? Meaning, are they going to promise more rate cuts to come? Or are they going to be hawkish about it and say, we're one and done unless we see additional weakness in the economy? In that case, the market is not going to like such a message and will probably find an excuse to sell off. All right. If you have any questions or feedback, put them down below in the comments. As always, like and share this video so the algorithm knows what's up. You can subscribe. You can subscribe to get more content or videos like this. You'll hit the bell if you want to get instantly notified. And remember, as always, I have a blog where I go into more detail at drduru.com/122. And you can see in the captions other blogs that I write for where I do more than just talk technicals. All right. Thanks for checking this in. Thanks for hanging out to the end here. Take care. See you the next time.